Welcome to our new podcast, like always with Guy Wagner. Good morning, Guy.
Good morning.
On the macroeconomic front, the first quarter of 2024 has passed without any major upsets. Although growth remains slow, just about everywhere. The threat of recession still looms large. What could be done to prevent it?
Yeah, I would say it will be difficult to prevent in the sense that when you look at the U.S. economy, because when we talk about recession, the market is especially looking at the U.S. economy. The U.S. economy last year, a lot of people were expecting a recession, but then the economic growth in the U.S. turned out to be better than expected. This was partly due to this idea of excess savings. So the idea that during the pandemic, households continued to receive their income, couldn't spend, and so there was some excessive savings they were able to build up, and they were able to draw on these savings to continue their lifestyle afterwards. But these excess savings have now more or less disappeared. Another factor which has helped the U.S. economy was public spending. Given that the budget deficit remains quite high, but there too this year it's not realistic to expect a further increase in public spending, given that we'll have the elections at the end of the year. So from that point of view, I think even though the market seems to say that the risk of a recession now is definitely no longer there, I think behind some of the good figures you see a real deterioration in the in economic activity in the US. So from that point of view, it's difficult to see nowadays what would what would stimulate the economy from here. Again, private consumption, which is the main factor behind the growth in the US, has been quite strong. So it would be a little bit unrealistic to expect that to increase even further. Public spending, as I said before, can't really be expected to be increased this year. Investments, companies' investments might get a little bit stronger, but even there, we don't see a lot of potential, at least for this year. And you have net exports, and given the weakness in the rest of the world, again, you don't see a lot of reason to be extremely optimistic on that. So from that point of view, I expect the U.S. economy to get weaker, contrary to what the market is currently telling us.
Let's stay a little bit at the US. There were also fears of recession in the US, particularly following the Federal Reserve's interest rate hikes. But this hasn't happened so far. Is this reasonably good news?
It is good news in the sense that the U.S. economy remains the main growth engine of the world economy. So from that point of view, obviously a strong U.S. economy is good for the world economy, especially given that the other engine, China, is relatively weak. So it's good news for the world economy. It's obviously also good news for the equity markets in the sense that companies' earnings are linked to growth. And so if growth is positive, normally that's good for companies' earnings. So from that point of view, it has been a good news, or the fact that the U.S. economy has remained relatively strong, even though it's not really very strong, but has remained relatively strong, has been good news for the world economy, yes.
In Europe, between falling industrial production and rising interest rates, the economy is suffering. To what extent is this a worrying situation for you?
Yeah, I think what's worrying about Europe is that the growth potential is not really very high, if only for demographic reasons. Demographic trends are even worse than in other parts of the world, especially the US. So from that point of view, our growth potential is not extremely high. And then the other thing is that the European economy is more dependent on manufacturing, which has suffered more given the increase in interest rates, etc., and is also to a certain degree more dependent on China, and the Chinese economy is also quite weak. So from that point of view, right now at least, there's not a lot of reasons to be particularly optimistic about the outlook for growth in the Eurozone.
The European Central Bank announced at the beginning of April that it wanted to keep interest rates high, but with the prospect of lowering them in June to stimulate the Eurozone economy. Does this amount to good news?
The problem for the European Central Bank is that when you look at economic weakness, clearly that would justify a cut in interest rates. But the mandate of the European Central Bank is to fight inflation. It's not necessarily to promote growth. And the inflation numbers have not been that good recently, in the sense that, yes, inflation came down in 2023, but is no longer coming down, at least for the moment, or at least not not quick enough to reach this 2% target that the European Central Bank has. So from that point of view, given the inflation numbers that we've seen recently, a cut in interest rates would be more difficult to justify. So there's this dilemma for the European Central Bank. They've announced that they want to cut interest rates during the summer, so that might help some sectors, at least, of the economy in the short run.
The central banks appear to be in a bit of a bind, doing what they can do to combat inflation on a long-term basis, at the same time as allowing government to finance themselves and limit the cost of servicing their debt. How can this dilemma, let's name it like this, best be resolved?
Yeah, I think first of all the dilemma will stay, in the sense that normally the mandate of the central banks is to fight inflation. You could say the Federal Reserve in America has the other second mandate, which is to help the labor market. But that normally are the mandates of a central bank. But nowadays we're in a situation where, given the very high debt levels, if interest rates were to keep rising, then obviously the cost of servicing that debt will explode. And that's a new situation. And I think in the end, the dilemma will be resolved by asking the central banks to make sure that governments will be able to finance themselves. So, and we might have a situation where, despite maybe higher inflation numbers, central banks will do everything they can to keep interest rates quite low.
As far as the financial markets are concerned, equities are still in favor and the indices are posting solid performances. How far can this momentum go?
Yes, you're right. The first quarter for equity markets was good, and you could even say that the last 2 months of last year also already had been very, very good. So since the end of October, equity markets have increased quite a bit. But one has to notice that there's a growing divergence between what the markets are pricing in and the economic reality. What I mean by that is that the rise in equity prices seems to be based on this idea that growth will reaccelerate, that inflation will rapidly come down to these 2% targets that the central banks have given themselves, that companies' earnings will increase, that in the beginning even of this year that the Fed will cut interest rate quite massively this year. And all these things have really turned out not really to be true, in the sense that this idea that the Federal Reserve will cut interest rates very strongly this year is no longer really valid, given the latest numbers on inflation. Especially companies' earnings are revised down in most of the regions and in most of the sectors. Bond yields are increasing again. Inflation is not coming down as quickly, and it has even recently proven or showed some increase again, especially in the US. So all the positive factors that were behind this increase in equity prices have at least for the moment, don't seem to turn out that way. And this divergence between what is priced in and the reality, I think would or argues for some caution when it comes to the at least short-term outlook for equity markets.
Technology stocks are more than ever driving the indices. Yeah, everybody's talking about the Magnificent Seven, for example. But isn't there a risk of overheating, and share prices can go on climbing forever?
Yeah, technology stocks obviously. First of all, they kept the imagination of investors. So, and obviously they are benefiting from long-term secular trends, digitization, cloud computing, artificial intelligence. All these things are obviously good for technology stocks. But the other thing is that the markets or equity markets are driven nowadays by momentum strategies. A lot of that has to do with passive investing. So people essentially are buying the stocks that have gone up the most, with the idea that they will continue to go up. And so fundamentals, valuations are not really taken into considerations. And that obviously, again, argues for some caution, or at least makes this quite a dangerous market. Again, there's this, especially for technologies stocks, there's this mixture between, on the one hand side, a very good, or at least for some of them, very strong secular trends. On the other hand, very high valuations.
On the other way around, Guy, the bond markets, which regained a certain attraction in 2023, are suffering once again. What this in your mind?
Yeah, I think the weakness, or the current weakness of the bond market is logical, in the sense that what we've recently seen is that in the US, growth numbers were a little bit better than expected, and more specifically, inflation numbers were worse than expected. And obviously, higher growth, higher inflation is not necessarily very good for bond markets. So we've, after having fallen very strongly over the last 2 months of last year, bond yields have again increased a little bit in the first quarter of this year.
However, you mentioned in the latest edition of Perspectives, by the way, which has just been published, that the bond markets of the so-called emerging market countries are regaining their appeal. Is this a good opportunity to watch for the future?
Yes, but I would say it's an asset class which is often neglected, because people still tend to view it as very risky and volatile. But the fact is that for a lot of these so-called emerging countries, fundamentals have improved quite a bit over the past years. And also one has to notice that, especially since the pandemic, or during the pandemic and the afterwards, say these countries often maintained much more orthodox monetary and fiscal policies, whereas we did basically the kind of things that we blamed them for in the past. So from that point of view, I think it's quite logical to see that the index of these emerging market countries' government debt is performing much better than the one of the industrialized nations, and has done much better since the pandemic, basically.
You also mentioned on the equity market that Japan continues to look really healthy. Is this clearly an attractive destination for an investor today?
Yes, I've often said that for me, Japan is maybe one of the most attractive markets going forward. And the reason behind that is basically better corporate governance. What I mean by that is that for decades in Japan, shareholders were not treated as being very important. Even profitability was not that important. What companies wanted to do was gain market share, and that often led to very low, to bad capital allocation, low profit margins, low profitability, and that made the Japanese equity market not a very attractive market. All this has changed some more than 10 years ago, or has started to change some 10 years ago with Abenomics, the program of the former prime minister. And then nowadays, over the last years, things have accelerated. And now you clearly see that this idea of shareholder value, which has been so important in the US market for the last 40 years, is starting to get more and more importance also in Japan. And when you look at that and you realize that the valuation of the Japanese equity market is still quite attractive, local institutional investors are still very much underweighted in equities, then you realize there's a lot of potential for that market.
Let's talk about China. The Chinese economy doesn't seem to be quite as booming as it was a few years ago. Is the Chinese equity market still an attractive option for you?
Yeah, I would say, to oversimplify a little bit, there are basically two possibilities when you look at Japan. One possibility is to conclude that China has become uninvestable, that you don't want to invest in China because the rules of the game are different. Clearly, the party's interests are above everything else. You either have to accept that or not. But so some people are saying, that's not a country I want to be invested in. Rule of law is maybe not so strong as in other countries, and that's completely legitimate attitude. The other attitude would be, okay, all this is true, but everything has a price, and if the valuation of the of Chinese assets is particularly attractive, I might still invest there. And that's the case right now. I think the equity risk premium of the Chinese market is above its level of the during the financial crisis, which is basically shows you that the Chinese market is very cheap, and from that point of view, it's attractive, or at least when you look, there are certainly some stock picking opportunities.
As always, Guy, let's wrap up with a final word on gold. The lights are still on green, with the gold pricing continue to rise higher and higher and higher. How much further do you think it can go?
I think it's difficult to have an official target when it comes to the gold price, but I still think that the medium to long-term trend for gold is still upwards. There might be some corrections. The rise has been quite strong recently, so there might be some profit taking. But longer term, I'm still very optimistic for the gold price. One has to note that the rise of the gold price last year and this year has taken place despite of rising interest rates, despite of a strong dollar. And normally, gold was inversely correlated with interest rates and with the dollar. When interest rates went up, given that gold doesn't pay any interest, that was bad for gold, and the gold price went down. And that was not the case during the recent rise. And I think that shows that behind the rise of the gold price, there are other factors. It's not really the financial demand, it's not the demand of investors, it's basically physical demand. And this physical demand is coming mainly from the central banks, and it's coming mainly from the central banks from the East. And all this has to do also with the fragmentation of the world economy, and I think that will continue. And when you look at gold as a currency, there's also a growing suspicion against the paper currencies, in the sense with these huge public debt levels, the growing budget deficits. Basically, a lot of people are saying paper currencies will become maybe not worthless, but will lose their value against a currency like gold, whose supply is limited. And so that's another factor which should help gold going forward.
Guy Wagner, thank you very much
Thank you
for your insights. More details can be found in the latest edition of Perspectives 179, available on the Banque de Luxembourg's website. Take care until next time. Thank you.
Thank you.